If you're making around $200,000 as a solopreneur, you could be paying around $60,000 in taxes. But here's the wild part. By implementing a few smart strategies, you could cut that nearly in half. That could be over $25,000 back in your bank account and not the IRS's. I'm going to walk you through how, step by step, zero fluff and 100% legitimate strategies. By the way, the final strategy in this video could save you over $15,000 in taxes, but missing any of these could have you overpaying the IRS by thousands. Oh, and real quick, your situation could be different. This video is meant to be educational and give you some ideas that could potentially work when applied to your unique situation, but of course is not direct tax advice. So with that out of the way, let's dive in. First up on our list is the simplest, health-related deductions. If you're paying your own healthcare premiums, you can deduct those entirely as long as you don't have access to another employer-sponsored healthcare plan like your spouse's. And if you qualify for a health savings account, you can contribute up to $4,300 per year. This is often an overlooked account, even though it offers triple tax advantages. You get a pre-tax deduction when you put money in, the money grows tax-free, and whenever you take the money out for qualified medical expenses, that distribution is tax-free as well. Assuming your annual health plan costs $5,000, you contribute the full $4,300 to your HSA, and you're in the 22% tax bracket, these strategies will save you about $2,000 in taxes. So from our original $60,000 tax bill, we're now down to $58,000. Next up, we have the Backdoor Roth IRA. Now to be clear, this won't reduce your tax bill today, but paired with everything else is a great move to build wealth tax-free. If you make too much money to contribute to a Roth IRA, which is $150,000 if you're single and $236,000 if you're married filing jointly, you can still contribute through the Backdoor method. Yes, I know this sounds shady, but it's 100% legit. Here's how it works. First, make a non-deductible contribution to your traditional IRA. Then you immediately convert that to your Roth IRA. And now you have $7,000 a year growing tax-free for your future. Keep in mind, if you have any traditional IRA balances, this drastically complicates things with a rule called the pro rata rule. So if this is the case, absolutely talk to a tax professional before trying to implement this yourself. Another quick note on Roth IRAs, since you've already paid tax on your contributions, you can actually withdraw your principal, the amount that you've put in, at any time tax-free. But if you withdraw any earnings from your Roth IRA before age 59 and a half, that will be subject to a 10% penalty plus ordinary income tax. So while the Backdoor Roth IRA doesn't lower your tax bill today, it does set you up to build wealth tax-free in the future. Now, let's talk about something that does impact your tax bill today and save you thousands of dollars in tax savings. As a solopreneur, you can set up a solo 401k and make contributions as both an employee and an employer. For 2025, you can contribute up to $23,500 as an employee and up to 25% of your net business income. Let's say you contribute $23,500. If you're still in that same 22% tax bracket, this will save you roughly $5,000 in taxes. So now your tax bill goes from roughly $58,000 to $53,000. Not only can a solo 401k help you save on taxes today, but this money is also invested for your future retirement. It's a win now and later. And real quick, if you'd prefer to pay taxes today, a Roth Solo 401k is also an option for your employee contribution. All right, at this point, we've already saved thousands of dollars from your tax bill, but this next strategy saves you thousands more and doesn't require you to spend any money. This is where things start getting serious. The Qualified Business Income Deduction, better known as QBI. If you run a pass-through business like a sole proprietorship, single member LLC, or LLC taxed as an S-Corp, you may be able to deduct up to 20% of your net business profit. So with $200,000 of net income, this will be a $40,000 deduction. But with the previous strategies that we've mentioned, we've already reduced your net income, so we'll call this a $23,000 deduction. In the 22% tax bracket, this saves you another $5,000. So our running total goes from $53,000 to $48,000. And it could get even better. If the big beautiful bill passes, which has not happened yet at the recording of this video, it would increase the QBI deduction to 23%, which would make it even more valuable. So at this point, we've reduced your tax bill by over $12,000, but this next one is a game changer for solopreneurs. Let's talk S-Corporation tax status, arguably the most powerful strategy in this entire video. If you're earning a solid profit, let's say $50,000 to $75,000 or even more, electing S-Corporation status can help you save big on self-employment taxes. Here's how it works. Instead of paying self-employment tax on your entire profit, you can pay yourself a reasonable salary and take the remainder as a distribution, which is not subject to self-employment tax. Using the same $200,000 scenario after implementing the tax strategies that we've previously mentioned, let's say that your new profit is 167 grand. All things held equal, you'd pay about $24,000 in self-employment tax in addition to ordinary income tax. But if you take $50,000 as a reasonable salary, you'll pay around $7,500 in self-employment tax. The remaining $117,000 of profit comes to you by distribution, meaning you pay zero self-employment tax on this portion. For those keeping track at home, you'd save around $16,000 in self-employment tax. Now keep in mind, there are additional costs and reporting requirements if you elect S-Corp status. For example, you'll need to file Form 1120-S on your taxes, which could increase your tax preparation costs. Also, since you now have to put yourself on payroll to pay yourself that reasonable salary, that could have costs associated with it as well. But with around $16,000 of projected tax savings, that's plenty of cushion to at least make this worth exploring. Last disclaimer on this, please work with a tax professional to determine your reasonable salary, because if you pay yourself too little, the IRS is not going to like that, and that could cause you some problems. So from our earlier number of a $48,000 tax bill, this could drop us to close to $30,000 to $35,000 in total taxes paid. So by combining all of these strategies, you could end up paying about half of what you would have previously owed the IRS with little to no tax planning. And it's all 100% legal, ethical, and used by savvy solopreneurs every single year. That's potential tax savings of around $30,000. Just by strategically setting things up and using the tax code to your advantage. If you want more breakdowns like this, make sure you tap subscribe. And if you'd like my help right now, click the top link in the description and book a free 15-minute phone call where you'll share more about yourself, your goals, what you're trying to achieve, and see if there's ways that we can apply these strategies to your unique situation and help you save thousands. Thanks so much for watching, and I'll see you in the next one.